Assalamualaikum warahmatullahi wabarakatuh, and good evening to Sir Naim and also to my friend. Today, my group are going to present about the Islamic money market product. So for the content for today, we are going to talk a little bit introduction about what is the Islamic money market and what are the product we are going to choose, what are the contract that involved in the product, and what are the difference between the Islamic product and also the conventional product that we're going to choose, and also a conclusion for our presentation. This is our group member, which is me, Istakif, and also we have Shashita, Daryl, Solihin, Rachel, and also Rilin. For the first one, I'm going to explain about what is the money market. Money market is the trading market that trade the short-term debt instrument between the institution and also the trader. So, investors that have a surplus fund, they can invest their money by buying the short-term debt instrument that also will help the institution, government, or also banking institution that need to fund their short-term needs, loan needs. And the short-term debt instrument, it is a low and less risky investment which in the 1 year or less than 1 year maturity. The example of product that we have in the money market is the commercial paper, treasury bill, and repurchase agreement, which is the repo. And what is the Islamic money market? Islamic money market, it is still same like a money market, but the market must follow the principle of Islamic law. The product must have the Sharia compliance. And from Isafal 2019, it states that the Islamic money market is free from any gambling and also uncertainty. And this is support for riwayat Muslim. It states that indeed Rasulullah SAW forbidden the sale and purchase of al-hasa, which is the throwing stone, and the sale of purchase of gara, which is the uncertainty. In the money market, also we have the swap and also option. These two are the derivative instrument in the money market. But for product that we are going to choose, we are going to choose swap. Why? Because Islamic foreign swap, the maturity of the product is less than 1 year. Compared to the conventional foreign swap, the maturity of the product is 5 to 10 years. So, we can conclude that Islamic foreign swap is the product of the money market because the maturity of the product is less than the 1 year.
Hi everyone, I'm Shashita and I'll be talking about our product. Now before I get into the Islamic product, let me just talk about the conventional FX swap. Now this is how it works. Company A already has 850,000 euros. Company B already has $1 million USD. This is the principal amount. They would exchange this amount. So when they exchange, Company B would get the 800,000 euros while Company A gets the million USD. Over time, they would exchange the interest payment in the currency that they had received the money in. For example, Company A earlier had euros and they had given to Company B and they received USD, right? So they would be giving the interest payment to Company B in USD. And this would go on upon the specified agreed period of time, and at one point once the term ends they would return the money that they had received early on. So earlier Company A received USD from Company B, so once the term ends they would return the 1 million USD to Company B and Company B would return the 850,000 euros to Company A. So basically, they exchanged their interest payments, which is profited from the money that they had invested from each other. And this can happen in both cross-country transactions as well as multinational transactions. Now, the contracts involved in conventional FX swap include these three primary contracts, which are the ISTA Master Agreement, the Swap Agreement, as well as the Credit Support Annex. Now, the ISTA Master Agreement just highlights general terms and conditions of the FX swap. And swap agreement talks about the details within the swap itself, such as the principal amount, the interest rate, the exchange rate, the termination terms, and the maturity date. The credit support annex talks about collateral terms and the valuation of the collateral in order for these customers of these conventional FX swap to mitigate credit risk and to ensure the investment is risk-free or at least has less risk. That is why a collateral is needed in conventional FX swap. Now, coming to the Islamic product, our chosen product is the Maybank Foreign Exchange Swap. And as mentioned earlier, it holds pretty much the same definition, which is an agreement where two different parties are able to exchange profit payments in the currency given from one stream for another stream throughout the decided time. Now, as I've mentioned before, conventional FX swap and the Islamic product both have almost a similar definitions, but how do they differ? Now, firstly, they both serve corporate clients, meaning big profile clients where there's tens and millions of ringgit being exchanged. However, the main difference is the flow of money and how the transactions are progressed within a cycle. For the Islamic product, first, Maybank, which acts as a representative, buys the commodity. This commodity can be anything based on natural resource. They would sell this commodity to client A at a deferred rate, and this client A will then sell this commodity in the market for a foreign currency. And now, this is where a markup is made, and the profit is made, and the profit payments are made. Now, client A would then buy the commodity and sell it to Maybank at a deferred rate again. And now Maybank would sell this commodity for its original price to get back their money. So overall, this is how the money flows within the product. However, I will let my colleagues explain in detail as to how it truly works and how the contracts are put in place to ensure it abides by all Sharia compliant laws and policies.
Next is types of contract involved in FX swap, which is tawarruq and
an Arabic term which literally means a promise or an undertaking. So in this context, in the context of Islamic finance, Wa'd refers to a unilateral promise made by one party to perform a certain obligation in the future. So what's the nature of Wa'd? So Wa'd is neither a contract nor an agreement. So it is a unilateral promise made by one party. So initially, it is not binding legally, but certain conditions can make it legally enforceable. So just some historical context. Early scholars like Sheikh Mustafa al-Zaka advocated for binding promises in financial contracts. In more modern views, jurists have varying opinions. So some believe unilateral promise creates liability for the promiser and confers rights to the promisee. So what are the origins of the concept of Wa'd? So the concept of Wa'd in the Quran is often associated with the promises of Allah, both of reward and punishment. So here are some historical examples from the Quran. So first we have Surah Al-Baqarah. So Allah promises paradise to those who believe and do righteous deeds. We also have Surah Al-Imran, which is Allah's promise that He will not waste the deeds of any believer, male or female. So we can tell that fulfilling promises is a spiritual duty in Islam. It reflects a believer's commitment to Allah's guidance and contributes to a just and trustworthy society.
Next is tawarruq. What is a tawarruq contract? According to the OIC Fiqh Academy, tawarruq is defined as a person or mustarik who buys a good on a payment basis to sell the goods at a low price to get cash. According to the Accounting and Auditing Organization Islamic Financial Institution Sharia Standard, tawarruq is a commodity purchase contract on a formidable basis through buying and selling on murabah contracts. The commodity is then sold in cash to parties other than the original seller. So where does the tawarruq contract origins from? From linguistic point of view, tawarruq comes from Arabic warq or warik or waraka, which means silver, money, dirham or silver metal. Earlier generations used tawarruq to obtain silver or dirham. To use the tawarruq contract. Tawarruq contracts are used in scenarios where liquidity is needed without incurring interest, and the transaction must comply with Islamic principle. So next question is why tawarruq contract is used in the FX swap. So first is the Sharia compliance, liquidity provision, risk management and flexibility and acceptance. So for the first one, it provides a Sharia compliant way to obtain and swap currencies without engaging in riba. It also effectively addresses the need for liquidity in different currencies. Tawarruq also helps in managing currency risk in a manner acceptable under Islamic finance principles. Tawarruq also is widely accepted and provided flexibility in structuring financial products while adhering to Islamic ethical standards. I will be explaining about Tawarruq contract, which happens after Wa'ad contract. So here you can see it's a first structure of a case study for investors that wants to change the money from USD to Euro for their own investment. So the first part, as you can see here from the diagram, the investor buys the commodity, which is the cash transaction. The investor buys a commodity worth 14.5 million through Bank A with cash. Next is investor then sells the commodity on credit. The investor through Bank A sells the commodity to Bank B at a price of USD 14.501 million on credit. The payment here is deferred for 1 year based on the forward rate. So the third step is Bank B sells the commodity for cash. Bank B sells the commodity to broker B for USD 14.5 million in cash. Bank B then converts the USD 14.5 million to 10 million euro using the spot rate. Next, we'll proceed to the second structure. In the third step, the investor haven't gotten the money yet in euro. We'll look into the number 4 steps, which is Bank B buys the commodity again with cash transaction. Bank B uses the 10 million euro to buy the commodity worth 10 million from broker B with cash. Then into the step 5, Bank B sells the commodity on credit. Bank B sells the commodity worth 10 million euro to the investors Bank A at a price of 10.141 million on credit, with the payment deferred for 1 year. This is also using a spot rate as well. Lastly, investor then sells the commodity for cash. The investor sells the commodity to broker B through the bank and obtains 10 million in cash. This finally completes the transaction of investor getting the money conversion into euro.
On the maturity date, as per the Wa'ad, company A exchanges euros back to USD with company B. But at this time, it will be at the rate agreed upon at the start of the contract. So how does it differ from a conventional forex swaps? So the use of Wa'ad ensures that the promise to exchange currencies in the future is binding only on the promisor, which is company A in this case, and is permissible under Islamic law. Also, the buy-al-sarf transactions are executed immediately with no delay in the transfer of currencies, which are adhering to the principle of immediate possession and avoiding interest. So this example demonstrates how Wa'ad and buy-al-sarf are used in Islamic forex swaps to manage currency risk while remaining compliant with Islamic financial principles.
Greetings to Sir Naim and my fellow classmates. So today, I am Rachel Christy Anna Jonathan with metric card number A2915 will be presenting to you the differences between Islamic and conventional products. However, before we get started, I would like to ask, have any one of you knows what is the difference between these Islamic and conventional products? No worries, because I will be explaining and guiding you what are the differences between the Islamic and conventional products. So, there are several differences between these Islamic products, which refer to the Maybank foreign exchange FX swap and the conventional FX swap products. So, to make it easier for you guys to differentiate it, I have specially prepared the slide in different colors for you guys to make it to easily differentiate it, where the Islamic products are in the orange column and the blue column are the conventional FX swap products. So let's move on to the first aspect of the differences between these two products, which are in the aspect of compliance. So for Islamic products, it fully adheres to the Sharia principles or the Islamic laws, where there cannot be riba, which is an interest rate. Second, there cannot be gharar, which is the uncertainty, and whenever they want to enter any contracts, they must have a valid condition, especially in the Tawarruq where they must have commodities when they want to exchange or they want to obtain the cash. Meanwhile, for the buy al-saf, they must have a valid reason when they want to enter the contract, such as when they want to go for travel. They can have using this travel reason for to enter this contract. And nonetheless, as I've been mentioned, whenever they want to obtain the cash in this Islamic product, they must have a commodities as the underlying asset. Whereas for conventional, it's all adhered to the conventional finance principles, where it involved the ISDA, which is the International Swap and Derivative Association Agreement, and then the swap confirmation, credit support annex, which lead to it sometimes called as lack transparency due to a lot and various involvement of contract, which is not compulsory for them to declare it whenever they want to enter the contract. But for Islamic product, just remember they must have a valid condition and they must declare every of the contract they enter to. Then, moving on to the second aspect, which is the interest rate. Just remember, Islamic products, as have been mentioned just now, they cannot be riba. So, this is because they must keep halal. Just remember, Islamic product, you must keep halal. So, no riba. But for the conventional, there is riba, or known as the interest rate. This interest rate is through the interest differentials. Then, moving on to the third aspect, which is the structure. For Islamic products, it involves two continuous parts or two continuous ways. But it's not two different ways, no. It's a two continuous ways. However, for conventional, it's only a straight and direct, which is only one part involved. So, for more details, is actually for Islamic product, it involves the Wa'ad contract, which is known as the unilateral promise, and the buy al-saf, which is the exchange currency, as the first part of the contract. Whereas for the second part, it involves Tawarruq contract and together with Murabaha contract and together also with the Wakala contract as agent or wakil to perform the contracts or the transactions. So the second part is actually the continuous part from the first part, whereas for the conventional part, it only involves the spot and forward transaction, which is combined together under one contract where it has a beginning and one at the expiry date of the contract. Next, in the aspect of underlying asset, as I've been mentioned before in the previous slide, there must involve commodities in the Islamic products, which is referred to the Maybank foreign exchange FX swap. One of the examples of the commodities are the crude oil, palm oil, and agriculture products. Whereas for the conventional product, there is none of underlying asset involved, as it is just a financial agreement between the parties involved. Then, for speculations, I know that many of you have wondered what is speculations. So, speculation is actually the process of making profit through the security of price changes between the security. Hence, as I've been mentioned before, I keep repeating that in Islamic products, there is no speculations involved, as speculation is actually involved uncertainty, which is a garar. So, this uncertainty is not adhered to the Sharia laws. Hence, Islamic product avoid the speculation, whereas for conventional products, they use this conventional product as to do the speculations to gain the interest and making profit from it. Then, moving on to the purpose aspect of these two products, I know that many of you have been also doubt that what are the purposes of these two products, which is the Islamic and the conventional. Although these two products is actually almost similar, having a similar purposes, but they are different in several ways where for Islamic products, it's actually for short-term hedging, whereas for conventional products, it's actually for a long-term hedging. Then the Islamic products is also function to provide the transaction that is free from interest rate and speculations which is related to the GARA. Whereas for the conventional, it is purpose to for the speculative occasions where they make the profit through the security, the changes of the security prices. Lastly, the most awaited questions I've known from you guys is how do these two products make profit? So for Islamic product, it is from the agency fee, which is a wakala. It is not from the murabaha, which is cost plus financing, but it is from the agency fees, wakala. But for your conventional, it is from the interest rate. As been mentioned from the previous, it is all about pre-interest rate, where conventional they are playing around the interest rate to get
Now
profit.
I'm going to talk about the contribution of Islamic swap. First, it promotes justice and fairness. By adhering the Sharia principle, the contract outlines all the specifics of the transaction, includes the currency involved, the exchange rate, and the duration of the swap. It also reduces exploitation through one, prohibition of riba, profit and risk sharing. Secondly, it opens accessibility for Islamic investor. It opens for Islamic individual investor that seeks the investment that compliant with the Sharia principle. Also, it opens accessibility for exporters and importers that dealing in international business transactions that have a wide base of Islamic customer base. Lastly, it opens accessibility for retail investors such as KWSP funds. As we know, most of the KWSP benefiter comes from Muslims worker. The third point is it promotes healthy investment environment by avoid excessive uncertainty, structuring transaction in a way that ensures clarity and mutual consent from both parties. Market liquidity can be bought or sold without affecting the price, allow investor to enter and exit quickly the market at fair price. Increase hedging, protecting the investor against currency risk, reduce the overall risk in the market. The last point is support Islamic financial institution. Short-term flexibility helps the investor to optimize their portfolio allocation over shorter horizon investment. Attractive returns. Short-term investment that comply with Sharia, it offers potentially lucrative returns for the investor that involved in Islamic FX swap market. Diversification product offerings market more resilient and attractive to a wider range of investors.
Now, after all the explanation, I'm sure many of you are wondering what is the main reason for the existence of this product and why is it significant? I think first, it's a very efficient short term risk management tool. The reason why we say this is because most conventional FX swaps that already exist in the market are usually long term and long horizon. So imagine when you're somebody who's facing risk, it will be much more easier for you to be able to evaluate risk in the short term in comparison to the long term. Therefore, this is a very, very efficient tool and it contributes something new to the Islamic banking and the finance industry as well. Secondly, it's specific and customizable. A lot of companies and firms will be facing different troubles and different risks at different times. Not all will be facing the same risk or the same extent of risk. Therefore, this will allow them to customize the contract to ensure that they get the best benefit out of it. Now, thirdly, it increases the opportunity for international experience. A lot of companies that exist out there that are Sharia compliant are often afraid to be able to, go up, across borders and open up companies in various countries. The reason is because they are afraid of multiple risks, the primary risk being exchange risk. Now, given that somebody is able to properly evaluate their risk, they're able to hedge that risk using this particular tool where they can hedge it short term, and this increases the opportunity for people to look beyond borders and increase their market and their target audience to a much wider global market, and now they can cater their products to other people out there. This is a very good opportunity for a lot of companies to expand and grow bigger and contribute economically.
For the conclusion, we can say that the FX swap in the Islamic finance are using a structure like a Tawarruq, buy out soft, Wa'ad contract that to make sure that they are the Sharia compliance by avoiding the riba, which is the interest, and they need to make sure that the product are following the ethical trade and also deferred payment agreement. By learning this product, we can know the certain definition for the contract that involved in the product, like the Tawarruq that provide the liquidity, buy out soft that provide the facilitate direct currency exchange, and Wa'ad, which is the contract that offer the bidding promise for future transaction. By knowing this product, furthermore, we can say that the instrument will support both individual and corporate needs while adhering the Islamic ethical standards in the product. Thank you for your attention and listening to our presentation. So next, we are going to start with the Q&A section. Okay, thank you for your attention and listening to our presentation. So next, we are going to start with the Q&A section. Okay, thank you for your attention and listening to our presentation. So next, we are going to start with the Q&A section. Okay, thank you for your attention and listening to our presentation. So next, we are going to start with the Q&A section. Okay, let's start with our Q&A section. Our group are going to prepare a few questions and answer for that question also. So let's start with our Q&A section. Our group are going to prepare a few questions and answer for that question also. So let's start with our Q&A section. Our group are going to prepare a few questions and answer for that question also. So let's start with our Q&A section. Our group are going to prepare a few questions and answer for that question. For the question, I'm going to ask about the why we are choosing the swap as our product for this Islamic money market. As I mentioned earlier, swap is one of the derivative instrument in the money market, and usually the foreign swap maturity is between the 5 and 10 years. And my question is why we are choosing the swap, and we consider the swap as one of the product in the money market. The answer for this question is because the Islamic foreign swap, the maturity of the product is less than 1 year or same or equal to the 1 year. So we are consider the Islamic foreign swap is one of the product of the Islamic.
Since I already have prepared a question for myself, now the question is, what non-Muslim investor can benefit from Islamic FX swaps? Okay, let me answer the question. First, the Islamic FX swap has a structure where it based on profit and loss sharing rather than guaranteed interest payment. This can lead to more equitable financial outcomes and align with the interests of all parties involved. Second point is diversification. Islamic finance offer unique financial instrument that can differ from conventional finance product. Non-Muslim investor can diversify their portfolio with Sharia compliance product. This will reducing the overall risk and potentially enhancing the returns through exposure to the different market segments.
For question number 3, so how the bank gains profit from using the FX swap contract? So the bank gains profit by through wakalah contract. The bank is appointed as an agent for the investors, thus gaining profit through the agent fee. Usually in other contract, the bank use murabaha to gain profit like in car financing. As we know in convention is called hire purchase. But in this contract, murabaha is not used as a profit gain but to fill the gap between bid and ask spread of currency exchange
So
process.
hi and welcome back with me for the Q&A session. So the fourth question, I believe everyone have been doubting, how does the transparency in the conventional FX is differ from the Islamic FX swap? So the answer is, I hope you guys do remember, I've been mentioned in my previous slide whereby I mentioned there is a lack of transparency between the conventional FX swap and the Islamic FX swap. Why do I say so? Because in the conventional FX swap, it involves a very complex terms, and it also involves the interest rate differentials, whereby this interest rate differential cause and lead to the potential of hidden costs of the product or the contract itself. Hence, when there is involvement in the interest rate involvement in the cost, this can obscure the true cost of the product. Hence, this one will cause the counterparty of risk management less transparent compared to the Islamic FX swap. Then, how about the Islamic FX swap are more transparent? I hope you also still remember at as the Islamic FX swap, they need and they must, it is a must to adhere to the Sharia laws, whereby there is no interest rate involved, and all the contract that be involved, they must declare it and they must have a valid reason. So all this, all this aspect or the reason is contribute to why Islamic FX swap is very or more transparent compared to the conventional. So I hope this answer your questions.
So, question number 5. In the context of Islamic finance, what are the key differences between Wa'ad, promise, and Akad contract? Here, the answer is while both Wa'ad and Akad involve agreements in Islamic finance, Wa'ad is a unilateral promise that is morally binding but not legally enforceable, whereas Akad refers to a contract that involves mutual consent and legal obligations between parties that can be enforced by Islamic law, Sharia.
Now, moving on for the last question from us. What are the ethical considerations in Murabaha transactions and how they differ from conventional interest based transactions? You can take a minute or so to pause the video and think of an answer. But this is the right answer. Firstly, regarding ethical consideration in Muabaha, there are four aspects. Number one, in terms of transparency, there is a huge transparency in disclosing the cost and the profit margin, which comes to the cost plus format financing format, which ensures trust and honesty. Secondly, it is commodity backed, which is also asset backed, where it aligns the ethical trading principles and avoids excessive risk and uncertainty. Thirdly, the profit margin through cost plus financing is actually fixed. So this avoids the exploitation of consumers and avoid them from being taken advantage of. Lastly, there is an emphasis on mutual consent where both parties agree and understand the rights and duties of each other. Now, moving on to the second part of the question regarding how does it differ from conventional transactions. Firstly, like we all already know, time and time again, through every group's presentation, conventional transaction, yes, does involve interest, and this can lead to exploitation and unfair advantage to lenders and borrowers. Now, variable interest rates can also exist in many conventional transactions, and this is a huge form of risk because there is huge form of uncertainty that extends from this form of transaction. There are also many hidden fees and charges that usually exist in conventional transactions, and as pointed out earlier by my colleagues, through transparency, where sometimes, even if the terms are stated, they are almost confusing to understand or are not properly disclosed, which may involve hidden fees and charges that consumers may not know of. Lastly, high risk investments in conventional finance can lead to ethical concerns and cause instability in terms of finances for the consumers. That is all for the questions from us.
So, hi and hello everyone. Let's move on to the next session, which is the Q&A session from the public or from our own classmate after we upload the video. So, there are several questions that we've been receiving. However, all these questions will be answered by each of the members of our group or our own team. So, hi and hello everyone. Let's move on to the next session, which is the Q&A session from the public or from our own classmate after we upload the video. So there are several questions that we've been receiving. However, all these questions. So without wasting our time, let us begin with the first question that we have been receiving, which sounds like how can the Islamic FX swap markets can be further developed to meet the needs of international trade and investment? So to answer this question, it's actually the Islamic FX swap markets can be further developed to meet the needs of the international trade and investment through few aspects and characteristics that the Islamic FX swap must and has been adhered to. However, today I'm going to just outline the main point, which is I believe that for the Islamic FX swap markets to be further developed to meet the needs of the international trade and investment is actually through the standardization, whereby we are all aware that all the Islamic finance contracts, including this Islamic FX swap, have been tightly measured by all the Sharia laws, whereby this is one of the requirements to maintain a clear standardization throughout the transaction and contracts involved. This is super important because it is to keep the transparency for all the parties involved in this FX swap markets. Hence, how we want to maintain this practice of keeping high transparency is still a big question. So how can we develop this? Actually, we must increase the standardization in this FX swap markets, and this is very vital for the international trade and investment, since transparency related to trust. So when we have a high transparency, we are trying to getting all the trust for all the parties involved in, or all the investor who is like willing to do the international trade and investment. Hence, this standardization is not only to foster transparency, but it's also trying to enhance the confidence in the Islamic financial product for all the consumer or the clients that are willing or have the needs and have the desire to do the international trade and investment. So, a clear regulatory clarity by the governments also play a very important role. So, for example, in Malaysia, BNM could actually provide a framework outlining the step of conducting the Tawarruq-based FX swap, because this is very important to ensure the clarity and compliance for financial institutions that are providing these FX swap markets. So that's why how can Islamic FX swap market can be further developed to meet the needs of international trade and investment is actually through the increasing of standardization, whereby through this standardization we can increase the transparency, which is really transparent. Where is there there is a clear transparency, there will be develop or foster high trust, so that this Islamic financial product can not only enhance confidence but also can attract this international trade and investment of demand. So I hope this answered the questions. So the next question will be explained by my second member, which is Istakif.
For question number 2, from our friends say that the Wa'ad contract that is involved in the swap is a promise. So they want to know what the promise that is referred to. So I will explain that the Wa'ad is mentioned it is referred to the promise between the two parties, which is the investor bank and the foreign bank. So both banks made a promise to pay back the money that they get from each other. For example, that the investor bank gets money from foreign bank and the foreign bank gets money from the investor bank. So they promise to each other to pay back the money using the forward rate that they agree at the beginning of the contract.
Now, from the questions asked to us from our classmates, one of the most important questions asked to us was, what are the potential risks of non-compliance in FX swap transactions using Tawarruq and Wa'ad, and how can they be managed? I think the risk of non-compliance can arise from the Sharia non-compliance itself, where the transaction structure already agreed by both parties does not adhere to Sharia principles, thus can invalidate Tawarruq contracts as a whole, and this can lead to significant effects such as reputational damage and legal issues. For example, the commodities involved in Tawarruq transactions may not be generally traded and may just serve as a facade for cash exchanges, which can also be considered as riba, as we know goes against Islamic principles. Therefore, one of the most effective strategies to mitigate this risk is number one, by ensuring there is proper monitoring, where a robust Sharia compliance system can be implemented to ensure all transactions are reviewed and approved by Sharia scholars. Secondly, there can be regular audits to ensure that there is ongoing compliance of such activities. The next risk is credit risk. This is where one party affected in the FX transaction is unable to fulfill their payment obligation and therefore they default. This can lead to potential financial loss for the other party. Now, the reason why this happens then combines another risk, which is the exchange rate risk or the market risk as a whole. This is where a sudden and unexpected devaluation of one currency can cause significant financial loss to the other party. Therefore, this can affect the profitability of FX swap transaction. So, how do we manage this? I think first, regarding the probability of default, it's important that such parties do not default on their own. So it's important to implement due diligence strategy where you conduct thorough assessments of the counterparty before entering the transaction. Second, there can also be constant monitoring of the economic market where conditions are not too volatile during the transaction, and strategies can be adjusted on a real-time basis where such issues can be mitigated.
For question number 4 from our friend, it say that since they are a prohibition of riba, which mean no interest, could an Islamic swap be more profitable than a conventional swap or vice versa? So for answer the question, I will say that the main purpose of the Islamic swap is not to gain a profit, but it is to avoid the fluctuation of exchange rate in the future when we want to exchange the currency. But if they want to know about the profit gains, bank can get a profit from the fee they charge to the investor to get a profit, because bank act as an agent for the investor, which is the wakalah. And in this product, the murabahah that we are using is not to gain a profit, but it is only to use to fill the gap of bid and ask spread.
Now, moving on to the next question. Our fellow classmate has asked us a very important question on how might conventional FX swap structure be modified to comply with Islamic finance principles. I think the answer to this is simple. Conventional FX swap structure has the aspect of interest rates within it. So one way it can be made to comply with Islamic finance principles is by ensuring that it is replaced by asset-backed or commodity-backed transaction. For example, Party A wants to exchange 1 million USD with Party B for, let's say, 800,000 euros at the spot rate. So Party A wants to receive euros, Party B wants to receive USD. So Party A can buy commodities first worth a million USD on deferred payment terms. Party A can sell these commodities to receive immediate euros. Party B needs USD. So Party B can buy commodities worth an equivalent amount in euros on deferred payment terms and sells these commodities for immediate USD. This is how Tawarruq can be implemented. Moving on, we can also implement Wa'ad for future transaction, where Party A can make a promise to buy a million USD from Party B at a future date, and Party B can have another Wa'ad agreement to promise to buy the equivalent amount in euros from Party A at a future date, and they can both do it at an agreed forward rate. This is one of the key methods to slightly modify the conventional swap structure without completely changing it. However, the considerations is important to ensure that they comply with these principles, where there is proper documentation, where everything is transparent and each step is ensured to be following Sharia compliance. Next, there must also be genuine transactions where there are real and verifiable commodities to be exchanged, so that there is no synthetic structures created.
Now I'm going to talk about What are the potential risks that can be associated with conventional FX swap for the participating companies and bank? First, we're going to talk about counterparty risk. This risk happen when one party to the swap agreement will default their obligation. This risk can occur any point of the life of the swap, especially during the times of financial distress or economic downturns. Second, economic risk. This risk happens when macroeconomic environment changes affect the value of the outcome of the FX swap. The third one is market risk. This risk is an This is the risk of adverse movement in exchange rate that affecting the value of the swap. This most likely happen during the periods of high market volatility, geopolitical event, or economic data releases.